6 questions for India with me, Punita Kumar Sinha. Over the next 6 weeks, I will ask and get you answers to 6 questions that are top of mind for everyone who's looking at the rapid unraveling of the India story. The question I'm asking today is, can Indians move from gold to equity? Gold has been in existence as an asset class for over 7,000 years. Gold coins date to as early as 3000 BC. The fascination for gold for Indians has been age-old. We have heard the finance minister several times dissuade people from buying gold. The FM, in fact, has stated that he would maintain gold imports for FY14 to 45 tons, flats versus FY13. India and China account for 37% of global gold demand. As we all know, gold has been the second highest contributor to India's import bill after crude oil. Gold formed 30% of India's trade deficit in 2011 and 12, and 35% in 2012 and 13. If gold imports were to reduce, India's current account deficit would come down to 2% from the current 4.5%. What would it take for investor behavior to change in India so as to make Indians shift from gold to equities? Joining us today to give more perspective on this topic are 3 veteran investors. John Hathaway, Senior Managing Director, Tokyo Asset Management, who manages $1 billion in assets as part of his gold fund. He's a veteran investor in gold in the U.S. My other 2 guests on the show are Madhusudan Kela, Chief Investment Strategist, Reliance Capital, and Amit Bhartiya, Partner GMO, who recently wrote an article on the present and emerging risks to the gold trade. Thank you all for joining me today. Thank you, Madhu, for joining us today.
Yeah, thanks, Punita. Great to see you.
So, I'm going to start my first question on what we are seeing in equity markets versus gold. So, look at the last 30 years. Sensex has actually outperformed gold. So, Sensex has given about 16% return and gold has given about 10% annualized return.
Yeah.
Yet, we're not seeing any shift from gold to equities. What's your reaction to that?
I think there are plethora of reasons, Punita, because as we have seen, any markets are basically cyclical in nature. So, even though gold has underperformed equity in the last 30 years, but in the last 7-8 years, gold has significantly outperformed the equity markets because Sensex is by and large there only, while the gold price, it used to be roughly 4,000, 4,500 in 2000 in rupee terms, and now 29,000. So, as we saw in equities in 2007, that whenever this trade becomes fashionable, and that is the time maximum amount of investment gets into that category of investment. So, gold clearly has has attracted a lot of attention not only in India but also worldwide. So, even though long-term performance is poor, but there has been significant outperformance in the short term.
Although just hold that thought, I'm going to turn to Amit and see what he has to say to that.
I think so. I mean, because Indians in some sense have been, had the foresight not to trust in governments, and that's what some of the Western investors have realized, about not trusting governments in some sense, and because India has run a very loose fiscal policy for decades. And that's what gold is effectively done to protect, purchasing power in rupee terms.
Amit, you've written in your article that some emerging economies, particularly India and China, are slowing, and that will curb demand for gold and affect its prices. But over the last 6 months, that gold prices have fallen. In fact, Indians and Chinese have stepped up their physical purchases. And in fact, Indians have actually imported 20% more this year. Doesn't that refute your logic?
Well, it could be a function of number of things, Punita. One is, market participants did realize that, it's possible gold curves will increase going forward. So it's possible a lot of gold that was, bought earlier was a preemptive measure, which I strongly believe. So if you look at, and the curves have actually increased. And I would argue that if the current account deficit doesn't really come down, then curbs on gold will actually increase going forward. So it was the right thing to do, basically to buy more gold at that point in time.
John, now turning to you, how do you respond to that?
No, I don't agree with that at all. I mean, certainly I don't mean to discount what's happening in emerging markets. And yes, they are slowing down. And so on balance, maybe that's a slight negative. But the thing that has driven demand for gold, and I don't believe in using annual flows as the primary explanation for gold prices. I think the more important thing is real interest rates, which are basically short-term interest rates minus the inflation rate. And today, real interest rates are virtually non-existent. They might be slightly negative. So that creates a huge incentive for capital all over the world, not just the emerging markets, to look for alternatives. And one of those alternatives has always been gold.
Madhu, turning to you now, in India, we're seeing real interest rates that are negative, and we're seeing high inflation, and that seems to be continuing for a long time now.
But that may change, because this year, if you see, there is no negative real interest rate. I agree with you that was the trend for last 4 years, but that need not be taken for granted for a long period of time. And again, you look at the kind of investment which is being made into gold or even real estate. It is still very minuscule as compared with the overall saving.
Amit, what investor behavior do you see in other countries in terms of gold versus equities?
If you look at other emerging countries like Turkey, which has always been a traditional buyer of gold, they have a different problem in some sense. But again, the opportunities are also there. Per capita income in Turkey has reached about $9,000. So there is more emphasis on consumption rather than saving in some sense. Also, traditionally, there have been other instruments available. For example, a Turkish citizen can always convert his money into US dollars. So banks do offer dollar deposits there. So there is not that critical for them to buy gold in some sense. Also, earlier in the year, countries like Turkey, their credit rating got upgraded. So there was a more emphasis on buying equities for that matter. So I would say it depends on a case-by-case basis.
Shifting back to again equities, the trend we are seeing towards equities versus gold. If you again look at over the last, say, 20 to 30 years, we've seen gold increase, the investment by Indians increase by about $35 billion. And the investment into equity mutual funds have gone up only by about $10 billion.
Sure.
So why do you think that's going to change again going forward?
It will change over a period of time, for a variety of reasons. Because the nature of people who are going to earn money, they themselves are going to change. The saving, as I was talking about these demographics in India, if you ask an old age person who is 50 or 60 years, gold is truly the investment for him. But if you ask a 25-year-old person, I think he will tell you, no, I want to invest part of my money in mutual fund, part of my money. And as the demographic dividends come more visible, I think the trend will be a gradual shift, Punita.
Let's talk a little bit about demand for gold and then the supply of gold, just to see what that might do to prices of gold. One of the things I've noticed is that India is a big importer of gold, but there don't seem to be enough reserves in India. Can you comment on that?
Yeah, I think, I don't again know what the reserves are, but I was just watching Mr. Agrawal's interview with Vedanta Resources, and he made a comment that there are enough gold reserves in India, but we do not have a policy as yet to extract those reserves.
Amit, do you have any view on what India needs to do to improve its gold reserves?
I think the important thing is to fix the economy. I mean, if you create jobs and if it is, growth comes back, then money will come back into system and, reserves will automatically increase. I mean, that's the underlying problem. Underlying problem is lack of jobs. It is not about gold reserves.
And shifting to supply, you talked about, obviously, the mines having to be explored and policies being set in place. But if you look worldwide, if the gold price falls beyond a certain point, then it would be uneconomical for mines to produce gold. And wouldn't that really give a downside protection?
Yeah, downside protection will be there. So we are not saying that gold is going back to 4,000 rupees per tola per 10 grams as it was 10 years back. So clearly these factors, the cultural demand compulsion in India, and also what is the price at which you can extract gold, will provide some kind of a downward protection. And what I have seen observed in the last many years, in some of these commodities, for them not to do well also means that they can go into a large period of consolidation as far as prices are concerned. And that is what happened in gold. If you take from 1980 till 2007, gold prices were same. So for 27 years actually people who bought gold in 1980 did not make any money. So maybe we are entering one such phase, at least in dollar terms. I don't know where the rupee is going to be, at least in dollar terms, where people may have to wait for a very long period who have invested at $1,900 or $2,000 to get returns from their investment.
Well, Amit, we've been seeing net outflows from gold ETFs. I think something about $18.5 billion has been pulled out from about March to June. But we've seen stepping in by central bankers to buy more gold. Pension funds have started to increase some allocation to physical gold. In fact, recently we read that the German central bank has repatriated some gold from France. How will that impact gold prices going forward?
No, but it's a very small part. I mean, if you look at the last 10 years of data, I mean, central banks have not been a major, force. Basically, it's about, what drives gold prices is consumers in emerging markets and not central banks and not really ETFs. So yeah, they are marginal players to that extent. So I wouldn't, put too much emphasis on that. And if you look at, let's say, even a state pension fund or university allocates $1 billion, I mean, what's the big deal? I mean, it's actually a very small percentage compared to their overall assets under management in some sense. So, I mean, at least I am not seeing any significant change in allocation to gold among our institutional clients.
John, turning to you, what are you seeing the pension funds and central banks do in terms of their allocations to gold globally? I'm hearing that some pension funds are increasing their allocation to physical gold.
Well, on balance, central banks are buying gold. So whether the Bank of India, Reserve Bank of India is selling or not, on balance, most central banks are buyers of gold. So that's point number one. Point number two is that pension funds, again, are very underrepresented in gold. And what I see more of than anything is interest in gold from institutional investors, pension funds, university endowments, because they recognize these issues that I've just alluded to with monetary policy being extremely, almost recklessly easy and potentially very damaging to the value of paper money. Gold provides diversification away from that. So we see on balance net inflows, despite this last 2 years, which have been very difficult, as you know, in dollar terms for the gold price. We see more interest today than we did 2 or 3 years ago.
I mean, do you have any views on what competitive devaluation by emerging economies for their currencies might do to gold since it's seen as a hedge?
Well, again, if you look at, the experience in Southeast Asia, basically, it's quite interesting because what we saw in extreme scenarios, right, when Korean currency collapsed, GDP collapsed, the Koreans basically came out and actually sold gold. The Koreans sold about 200 tons of gold during that time. I mean, they've been historical buyers of gold. So basically what happened was gold in local currency terms basically did well as a store of value. But what happened in dollar terms, actually gold did nothing. In fact, money went back to US. The S&P did very well and the dollar actually strengthened.
We'll take a short break now. Let me shift to now another important topic, which is the price of gold, because that is obviously going to have a huge impact on the consumption of gold by Indians. So, first of all, what do you think is going to be the price of gold 5 and 10 years from now?
I think in 5 or 10 years is very, very difficult to predict. All I can say is, and neither am I a gold expert in that sense, but I feel that, this outperformance of equity in the longer term has to clearly be more visible, because equities as an asset class, you keep earning something every year. So by definition, your valuation is going down. But in gold, there is no earning. So there is no reason why a gold in a longer time frame should outperform equity.
And John, what is your view?
The price of gold, I can't conceivably make a guess on that. I think it'll be higher. I think it'll be substantially higher.
Now let me ask Amit and see what he says.
No, again, Punita, for gold prices, while, in dollar terms, I'm not so enthusiastic about gold, but gold in rupee terms, again, is a function of your exchange rate, because that is driving gold prices much more than gold prices in dollars. So if you look at the last couple of months, well, gold has been stabilizing in dollar terms, but the new high in gold prices in rupee terms is effectively just the exchange rate depreciation and the increase in customs duty, basically. So if the currency depreciates, gold price in rupee terms can appreciate.
John, based on your experience of investing in gold for over a decade, what is your view on investors shifting from gold to equities and vice versa?
Well, in the U.S., gold has never been, certainly in the last 30 years, has never been an important strategy. It's completely different than the landscape in India, where gold is central to how people invest. And I think that's just a difference. It's a cultural difference. It's historical difference. My view, though, is that I don't know what India is going to do over the next 10 years, but I'm fairly certain that gold will come more into the mainstream in financial markets like the U.S. and Europe, where it's basically been an outsider.
Amit, do you have a view on why Indians are over-allocated to gold versus equities?
No, I don't think so. I mean, the problem has been, equities have been such a terrible asset class over the last, maybe 10, 20 years. I mean, you have, in fact, I would say India has been in some sense an extended bear market. You have these, 2-3 years of bull market, and effectively, the market eventually collapses, because if you have a high inflation in an economy, or you have unpredictability in an economy, then it's very difficult for markets to do well in that environment. So given in an environment where you have financial repression, there is no effectively capital convertibility. Gold is effectively the only legal way to keep dollars in the country. So it's not about over-invested. It is about insurance. It is about capital preservation in the country.
So now someone had to build a gold portfolio. Right now, of course, Indians, most of it is going into jewelry and physical gold. As you yourself have pointed out, gold ETFs are not that sort of prevalent. So what would you say to people who want to invest in gold? What are the different instruments they should be using? And what's your view of gold mining stocks? I know there are none in India, but there are lots of them globally.
I don't have a view on the gold mining stocks, but I told you what my gold view is. I think whether you and I like it or not, because of the traditional thing, people will buy only physical gold because that is what gives them satisfaction. And plus, in a small village, I come from a small village, there is a tendency in people that the gold is real insurance, which I have. That if I bought some gold in the time of crisis, at least I can go and sell. And whatever, if I take jewelry, my husband, even if you belong to a lower middle class India, he will not be forcibly able to sell my jewelry. While the money in the bank account can always be spent. So
in terms of people's portfolio, what would you say their allocation should be to gold overall versus equities?
I think maybe 5% of your overall portfolio can be in gold, depending on what your aspirations are. But I would not recommend an allocation of more than 5% in gold.
Including physical gold?
Yeah, including physical.
But I think I've seen numbers that range anywhere from about 10 to 25%.
But I would say definitely, given the outperformance, and you're talking of incremental, if you are building a portfolio today, I wouldn't have more than 5%. And if you're like a 75-year-old, then you can go up to even 10-15%. But I wouldn't recommend take a 25% allocation.
Do you think gold is risk-free?
No. No, it is not. Because you've seen in dollar terms the price of crashed 30%. People don't realize that, for those 27 years you may have felt that you have not lost money. But if you put your money in a bank deposit, that would have been 27 years to have gone 4-5 times. The risk is also not being able to make money.
Amit, turning to you, what is your view on what is the right allocation of gold in a balanced portfolio?
From an Indian context, it should be high, specifically because again, there is no other way effectively to keep your money out of the country. So that's important. And again, it serves a good insurance because the question is what happens in the next 4 or 5 years? Which is the government that comes to power? What kind of fiscal policies they adopt? Are you in a very high inflation environment over the next 5 to 10 years? And if you are, then the currency will depreciate in line with inflation differential. So your gold effectively will hedge that.
John, continuing with the thought on allocation, Indians have liked gold historically and are overexposed to gold versus equities. What is your recommended allocation to gold?
Well, right now, to me, gold is at a point at which it seems positioned to do very well. So if I had a large allocation, as you're suggesting most Indians have, I wouldn't disturb that. And if I were underweight, I would own more. And I have no problem with a 25% allocation to gold if that's the comfort level with Indian investors. And frankly, I think if I understand it correctly, a lot of that allocation is not in the form of marketable securities. It's in the form of physical gold held outside of the financial system. And I think that's sort of the result of history in India. So I really can't comment on whether or not 25% is the right number, or should it be higher or lower. I really can't comment on that. But in the U.S., we typically counsel institutional investors that 5 to 10% makes sense.
Amit, what do you think Indian government needs to do to encourage the shift away from gold into equities?
If you look at gold in Indian rupees, it's a function of two things, right? It is gold in dollars multiplied by the currency exchange rate, right? So historically, the currencies have depreciated in line with inflation. So what determines gold prices in India is effectively your exchange rate and gold prices in dollars. So that's the only way you can protect your purchasing power in dollar terms, basically. And so that's why the 25 may look high in that respect, but again, given the lack of alternatives, maybe it is low. So it would be interesting to see, some of the other instruments what the central bank is thinking about, inflation-linked CPI bonds, and maybe that would be a good alternative.
So, Mother, what more needs to be done in terms of policy framework to encourage people to shift away from gold to equities?
Clearly, we need a much more decisive policy. Some of it has happened in the last 6 months, and I think this needs to be more decisive. When if we can't afford more than 400 tons of gold, so be it. So whatever is required to be done to ensure that we don't have more than 400 tons of or 500 tons of gold imports in India. So that looks what we can sustain in the longer term to be put in the policy side. And secondly, whatever is required to make this financial product as a better alternate to gold investment should be done. Right? There's a lot of work which can be done on the insurance side, but to make sure that insurance industry itself is being freed up. Because it's the only country in India where you have this bank insurance model, where one bank can sell one insurance company's product. We have seen worldwide trend that whenever this is being unbundled and you have more competition in the sector, clearly a lot of investment, comes into these sectors.
Thank you all for joining me today. As we've heard, there's a unanimous view that Indians are over-allocated to gold and need to be mindful of that. Clearly, it will take time for that investor behavior to change. After all, this asset class has been in existence for over 7,000 years. Gold is one of the few asset classes that offer consumption and investment value for individuals and a reserve currency for central bankers. That's why it makes it so hard to predict its price. John's of the view that gold prices will head higher and others are not so optimistic. Based on history, when gold prices turn down and a correction happens, it is not uncommon for gold to fall 50 to 60%, and we are halfway there. Regardless of what happens to gold prices, Indians are over-allocated to gold versus equities. Policy actions have been taken to curb demand for gold, and more needs to be done to improve India's own reserves of gold and curb further imports. Hopefully, all these measures will create an environment for Indians to allocate more towards equities, taking share away from gold. With that, it's a wrap on this edition of 6 Questions for India. Thank you. Next week on 6 Questions for India with me, Punita Kumar Sinha, the question we are asking is, can India deepen its debt markets? And what more needs to be done to make India's debt markets more globally linked?